Hey, good morning, everybody, and happy Friday. Welcome back to Mining Stock Daily in this week's long form episode. 2 segments for you in this episode as we begin to wrap up 2025 and what has been an incredible, very eventful year, and hoping more for the best into 2026. So we've got 2 segments. First, we welcome in from Cambridge House and our host at the Vancouver Resource Investment Conference, Mr. Jay Martin, talking everything, looking back on this market, his thoughts on moving forward, and then a little preview of what VRIC has in store for everybody. And then we welcome in for the first time on the podcast, Mr. David Garofalo of Gold Royalty. Our friend Michael McRae, correspondent, recently coming in, and Mining Stock Daily has that interview for you with Mr. Garofalo. So excited to share that conversation and his insight on this market and what the royalty space has been. Lots of interesting stories out of the royalty space this year. Special thank you to our ongoing sponsors throughout the year: Equinox Gold, Revival Gold, Integra Resources, and Vizsla Silver for their continued support of this podcast. We're going to have a very busy next couple weeks trying to get those end of year interviews and corporate editorials out to you, the listener, and then preparing for the new year. All right, everybody, let's jump into it. Here's Jay Martin and then Mr. David Garofalo coming your way. Be well. Hey everybody, welcome back to this week's long form episode on Mining Stock Daily. We are about 2 months away, a little less than 2 months away from the annual pilgrimage up to Vancouver, which happens every late January for the Vancouver Resource Investment Conference. Always look forward to that. And so to kind of prepare ourselves and to get the word out there, we've welcomed back our good friend from Cambridge House and our host at VRIC, Mr. Jay Martin. So Jay, good morning. Good to see you.
Trevor, it's great to see you. I'm looking forward to catching you in Vancouver. And congrats on the growth of the platform, man. Clear Creek's blowing up and you guys are publishing all kinds of content and you publish daily. It's a huge lift, man. So congrats. And we're lucky to have you in the industry.
Thanks. I really appreciate that. Yeah, the network's it's grown quite a bit, and we're seeing a lot of pickup in traffic to the website anymore. So more to come in 2026. We are hoping so. Some good things happening. But hey, listen. It's like the usual suspects are back. In late January, you get a full boat of speakers over 2 days. But obviously, the market in metals and resources is quite different than it was a year ago. But Jay, I remember you and I chatted almost a year ago, actually. And you had talked about how, momentum, it seemed, just looking at the numbers and looking at the activity at the 2025 VRIC, that, there was a lot of momentum. It seemed things looked really good. It was better than it had been previous years. Well, here we go. We've had just an incredible year within the metals, the miners, and the resource prices. And so it kind of like set the tone here. I mean, my goodness, what are your expectations for 2026 if we're going to continue this momentum?
Well, my hope is that this gold market continues to roll out with the moderation and the patience that it has. And over the last year, there's been moments where I think myself, probably yourself, many gold investors questioned if it was getting pretty hot out there, right? It's getting a little bit frothy. And I want to put that in context in a minute. But if we really go back to the 2022 central bank gold buying and record amounts that began to eventually move the hard asset price, but the equities didn't move at all. And investors were so frustrated by this. They're like, gold is running, the equities aren't performing, what's going on? And, 12 months later, the best in class equities began to, right? The Wheatons, the Newmonts, the Agnicos, this is through 2023, about a year later. But anybody who was investing in developers and explorers was frustrated and impatient, saying, look, the mining industry is running, but these smaller companies aren't getting any love, right? Fast forward another year, and the funded developers started to catch a bit of a bid. And so it's been like a very slow and methodical trickle of capital from the most stable and boring part of the industry, which is the hard asset, down to the equities and down to the smaller equities. And that's a healthy bull market. It's like the most textbook bull market that you could ever wish for. And so my hope is that that cadence continues in 2026. Look, it's a gold market. We're going to see ups and downs inside of the secular bull. We always do. And investors always get shaken out. When that happens, they lose confidence, forget the thesis, and sell, right? That's going to happen. Yeah. That's going to happen too. Inside a secular bull, you have the volatility. But my hope for 2026 is we continue to see that same cadence, that same slow, intelligent trickle of capital going to just a bit earlier in the industry than it was the year prior. And I think this is the year for, either any earlier stage companies with world-class management teams or sitting on a world-class asset. They're going to catch the spotlight. I don't think it's a rising tide lift all boats market coming up. I sure hope it isn't. I hope we see more of the same that we've seen over the last 4 years, which has been incredibly healthy.
What about the last, 12 months has really surprised you? I think, you and I are like-minded. We expected the metals to rise, maybe not at this velocity. Maybe we weren't expecting $4,200, $4,300 gold, $60 silver, basically. I mean, maybe that's a surprise, but other than that big velocity, is there anything kind of underneath the surface that you've paid attention to that maybe caught your surprise?
When we see metal prices run like that, we start to see generalists and mainstream media talking about our industry. And one thing that I heard a lot from fellow gold investors, people that have been in the industry like you and I long before anybody cared, right? Like long before it was cool. They got really cagey really fast. As soon as they heard any mainstream pundits talk about gold, people began to think we must be getting near a top. This is getting way too frothy, way too popular for the contrarian bet that precious metals has been. And I understand why people feel that way, but that's more a symptom of the last 15 years. It's PTSD from the last 15. Gold investors legitimately forgot what a good market feels like. They forgot that other people are supposed to care, And so now that some people do, and it's on the margin, it's not many. When gold hit its all-time high, maybe a month and a half, whenever it was, about a month ago, I started getting phone calls from friends who have heard me talk about gold for 13 years and never put any in their portfolio. And now they were calling saying, hey, like, what's a good gold asset to buy? And you can imagine my frustration, like, now you want to buy at this hockey stick moment? What? No. Right. And in good faith, I couldn't recommend anything. I was like, I guess, you've been in the game long enough. You'll learn about giving stock tips because everybody thinks they're an investor. Most people are really just trading share prices. And unless you really understand somebody's time horizon, you shouldn't give anybody recommendations because you're probably not thinking the same way. But, that was what I was seeing, was gold investors forgetting what a good market feels like. And at the first sniff of anybody on the margin mentioning the sector, they began to get cagey and worried, which is fine. Like, it's good. And it's a symptom of the last 15 years. It's pattern recognition, but it made me laugh, to be honest.
Yeah, you just did a great job of expressing the sentiment trade that led into the fall. And I think Beaver Creek Precious Metals Summit was a big sentiment moment for me, at least internally, because I sensed the froth from like the first couple hours that I was there. Things did die down. We're no longer seeing, gold all-time high little chyrons on the financial media. I will say, and this is maybe two quick anecdotal thoughts here, Jay, but it kind of pairs well with the sentiment discussion is, I usually listen to like the Bloomberg audio once in a while when I'm in the gym, and I just have it on to keep track of anything that's happening in markets. And they broke in and there was a precious metals financial, advertisement within Bloomberg. And I was like, well, that's funny. Usually it's a crypto, some sort of crypto advertisement. So this is interesting. That's a different twist. So you're seeing these bullion and financial
the biggest
institutions
in the world now. Yeah, like Sean Ryan now covered in gold sponsors. Tucker Carlson launched his own.
That was the other. That was my number two. I was like, Tucker
Battalion
Carlson.
Metals, right? Like, I've always been a gold guy, he says.
Yeah, he'll be at VRIC
Okay.
in 2027, I hear.
Right. But look, like we gotta feel good about that. This is what people have gone through so much pain for, right? And that's not popular sentiment yet. It isn't at all. I mean, as soon as gold corrected from those all-time highs, my generalist friends stopped calling, asking, I don't want it anymore, right? So I missed it, right? I missed the gold market. It's like, okay, you'll call me when it hits all-time highs again. I know what'll happen here.
Yeah, absolutely. Let's talk about the macro behind all this and what's really pushing this thing up. I got a note here, and actually I missed this a month ago, and so it's kind of silly. But go back to October. Federal government of the United States took in a record amount of tariff revenue in October, so it's pretty good on the surface of that. But it also ran the highest October budget deficit on record. The Trump administration spent 284 billion more than it took in to kick off fiscal year 2026. I don't think it's any surprise is in October is when we saw this gold market kind of pick back up again, after a little bit of a correction. The fiscal policy, as much of as it is a campaign promise when you're trying to get elected, is easily thrown out the window almost immediately. And it's not just the United States. It's every single government with a central bank that can print its currency. How are you watching the macro behind the precious metal move here in this fall?
You nailed it. There's nothing new about that pivot, right? There's a promise from a podium, but when you're in office, it's like the job description actually changes because the people that voted for your good long-term intentions now want immediate gratification. They don't actually want the thing they thought they did. And so, in democratic countries, our politicians are incentivized to give us immediate gratification, short-term delivery. And nobody's going to stay in office by promising the public, look, like we're gonna roll out some very serious austerity measures. This is going to get really tough for about 6 to 8 years. But on the back end of that, we're going to come out stronger than ever. Now, anybody who's ever accomplished anything great knows before the long-term gain is short-term pain. That's guaranteed, 100%. But no one's going to vote for that. No one's going to reelect that, right? And so that's why we always see this. I will fix it. I will drain the swamp. I will clean up the balance sheet. That all sounds good. I'll vote for that. Perfect. Once you're in office, I want my life to be better tomorrow. Okay, right? And that's how politicians are forced to think because that's how the incentive structure works. It's, we've built this system and it is the best option available. But, I think when it comes to the metal thesis, and people call it the debasement trade, right? That term has been thrown around a lot. And I think that's sort of a symptom of back to most investors being more traders of share prices than actual investors. They think about buying gold as the debasement trade. They have to add the trade thing because maybe they traded the share prices of cannabis companies in 2018, then they traded crypto in 2021, and then they're trading AI over the last 18 months. And from their perspective as a generalist investor, gold is just the next asset to run. That's all this is. It's the next thing that's hot. I should trade it. But obviously, gold's a bit of a different asset. Good news for gold investors is usually bad news for pretty much everybody else because it's the smoke signal. Something's going wrong from a monetary standpoint. And the debasement trade mechanics, I think a lot of people are going to learn this. They think they're getting in and out of something. But if they're getting out of cash and into gold because the cash will be worth less in the future than the gold will be, what will make them go back to cash? Like the second part of the trade actually doesn't ever materialize. And I think people will realize that once they're in it and once they're waiting. But, there's two core assumptions that they're the same assumptions that central banks made at the, early in the decade. The same assumptions that investors today, retail investors that are participating in the debasement trade are making. And that's that cash, US dollar, will be worth less in the future than it is today. And the second is that US geopolitical strategy will be less predictable in the future than it is today. And as long as those two things are in play and you still believe those two assumptions, then the gold thesis is still intact because it's the one asset that lacks the counterparty risk, that can dilute it at will. And it's the one asset that actually performs as a lifeboat. You can step off the chaotic train, step off the volatility and the unpredictable nature and sit on this safe haven asset, the lifeboat asset, and wait things out. I mean, that's the central bank strategy. That's what the hedge is all about. We don't know which direction we're going globally. Geopolitics is incredibly unpredictable right now. We can't tell you what countries will be allied or adversarial within as short a time period as 5 years. And if we don't know that, we need to step off and get on the sidelines and wait and just let this thing shake out a little bit before we choose where to pledge our allegiance. And so, that's been the thesis. That hasn't changed. And until it does, the gold market is very much still in play.
Yeah, I was pushing back when we had a label of why gold was running out. They called it the debasement trade. I was like, oh, we have a label of this trade now, like everything else.
Yeah,
in
exactly.
Markets that catches attention.
Yeah.
But I the reason I kind of challenged that is because we haven't even seen debasement, Jay. I mean, you talked about possibility of needing austerity. I don't even think austerity is any sort of option, just given how much trouble the developed world is in. I've been reading Ray's Dalio latest book, and he has written about austerity measures and how just unlikely it is because it's so politically unsavory for anybody involved. And so real debasement, like printing, like, I really feel there will be a time, and probably not terribly long in the future, where you remember like in COVID, we were like, oh my God, they're printing they're printing $3 trillion. Now it's another $5 trillion. So we had like $7 trillion of cash that was just created and handed out to people. I really feel there's going to be a time where we're going to look back at that and like, man, that was like child's play.
Yes.
When you're talking double digit of trillions.
100%.
That's going to be real debasement.
100%. And we're already seeing the early stages of that. And your comment about October, record tariffs, yet somehow we ran this amazing deficit. The United States doesn't have a revenue problem. Raise all the money you want. It doesn't matter. It's a spending problem. It will spend the money if it comes in, guaranteed, right? It's not a revenue issue. It's a lack of discipline on the spending front. Any new dollar that comes in will be allocated twice over immediately. But, you look at this, what you just said about us just beginning to see the early innings of debasement, what it might end up looking like. And I think you're absolutely right. And I think this is the angle behind reindustrialization that not enough people are talking about, but I think is very real. If the United States really wants to reshore and reindustrialize and rebuild the manufacturing base, we have a recent example of what that looked like. This is the industrialization of China over the last 30 years. And they had to borrow about $41 trillion to do it, to build what became the most advanced, manufacturing hub in the world with all sorts of specialized economic zones and very coordinated management, the refineries right beside the component maker, right beside the deep water port. Like, it was very structured and organized, but very, very expensive. And that's the key thing. $41 trillion over the last 30 years. What's that going to cost in today's dollars, right? And by the way, United States borrowed $31 trillion in that same time period, that same 30-year period. But they spent their money on, funding overseas wars that they lost, bailing out banks for fraud, and funding stimulus packages to buy goods largely made in China. Like, there's good debt and bad debt, right? You can acquire debt, but it really matters what you spent that debt on. Did you spend it on assets and cash flow, or did you spend it on memories and high fives, right? It's not the same, right? And if we take reindustrialization seriously, we have to look at the bill. And over the last 6 months, we've begun to see what this is going to look like. This is the United States government opening up their checkbook and funding our industry, right? 15% in MP materials by the Department of Defense, 10% in Lithium Americas, 5% US antimony, 10% in Trilogy Metals, a $35 million check, right? They're investing in, and we can get into this. I mean, why there's suddenly 60 metals on their critical metals list. But like, this is going to be an expensive endeavor. This money is going to get printed out of thin air to finance this build. That will be the most inflationary phenomenon we could ever imagine.
Yeah, we've talked in depth about all of those stories, but the principle about, the philosophy of where capitalism is in the United States when the U.S. government and the Department of War is taking equity positions in some of these companies. And I will say, like, I've probably maybe come off the ledge on that over the last couple of months. Like, I tend to see the reasoning behind it. And obviously, like, listen, if the private sector and the investment community hasn't been willing to fund some of these endeavors for the last few decades, then it will fall on the federal government to make sure that these things happen, especially when you have, the priority to resupply your manufacturing and remilitarize the military, I guess. The Lithium Americas one is still like, I still don't get it, because it's like, why invest in this lithium project when you're literally trying to get U.S. manufacturers to go back to internal combustion engines? I don't get it. The story doesn't compute with me.
Mm.
So that's
What?
what's your thoughts? What's the philosophy on capitalism and U.S. government taking positions?
Man, a couple of things. So what you just said about Lithium America. So this, like, call it state capitalism. That's what it is. It's the state participating in capitalism, right? And that's a dirty word in the West, and I find it distasteful personally, but turns out no politician cares what I think. So that's what's going to happen. Am I on the ledge or off the ledge? I tend to think it doesn't matter. I have high conviction. This is something we're going to see a lot more of. When you see deals like this get done, it's a mistake to look at it and say, oh, we did this special deal with MP Materials or this special deal with Lithium Americas or Trilogy. It's never that. It's always part of a trajectory, or it's new precedent, right? And new precedent has now absolutely been set that this is the standard, right? This is the standard we can expect in the future. Whether or not all these deals make sense, we're adopting a strategy that China has utilized for the last 30 years. I mean, that's really what's going on here. And people don't like hearing that, but state capitalism has been the path of success in China over the last 30 years. There's a lot of problems with it. A lot of money was wasted and a lot of reasons why I don't think it's going to be as effective in the next 30 as it was for the last 30. But in the meantime, there is a example of this working very well in the East. And the United States is now looking at that and saying, yeah, we can't wait for the private sector to catch up. We need to put this thing on steroids. So we're going to inject a bunch of capital into it. But they're applying a tactic without a real strategy, right? Now, China did that, but they think in 10-year time horizons. Every 5 years, they announce the new 5-year plan. And the 5-year plan always comes with the next 5-year speculative plan. And in 2026, they'll announce the 15th 5-year plan. They've done this every 5 years since 1947, absent a couple of years during the Civil War. And it's long-term thinking that you can get away with when you don't have to worry about elections, right? You can just, the political will doesn't matter. You just force your agenda. It's the same in the kingdom, right? That's why, I think that's one of the reasons why Trump's been building ties with Saudi Arabia, because they might need to borrow some political will to get things built in the kingdom that they just couldn't get built at home. But, so we're applying some of the tactics. I don't think we have the strategy. I would prefer the government out of my business. If they're going to be in my business, I think their role should be to clear the path, right? You can go to work slashing regulation, right? And all the processes that slow down production, but maybe leave the capital to the private sector. That would be my desire, right? Now we're seeing both, right? The Trilogy Metals deal is a great example. That was a good asset. The problem was you couldn't get there except by air or water. The Ambler Road was blocked under the Biden administration. And right after the US government wrote that $35.6 million check, they coordinated the Bureau of Land Management to get the road built. So now that road will be built. And that just means, like, this new activist investor at the table, being the US government, they are an activist investor. They don't just have deep pockets. They're also going to bend policy to their preference, right? That's the part that I'm in favor of. Like, if we're going, and only because, as you know, Trevor, we're in an industry that was nothing but vilified by our politicians and our political leaders for the last 15 years. Any extraction sector was not in my backyard, right? We're not going to support that sector. We're going to tax it to death, regulate it out of existence. We're going to crush sentiment in the media. It's all bad. It's all bad. It's all bad. Now we find ourselves in this pickle where we don't have secure supply over any of the stuff we need, right? And this is a problem. So the political sentiment shift, I'm hugely in favor of, right? Whatever reason that happened, it's happening now. And suddenly political leaders in the United States and Canada and Australia have turned their attention towards the necessity of securing supply over materials. And they're going to go about securing that with cash and policy. Policy, I'm in favor of. Cash, I'd say leave it to the pros, because I think the government trying to fix a corporate issue is like trying to land an airplane using a sledgehammer. Like, you'll get the plane down, right? But I don't know if anyone's going to be alive at the end of it, right? So it's a bit concerning, but it is the direction we're going, whether I like it or not. I feel very convicted about that.
This actually kind of piggybacks on the presentation I'll be giving at VRIC, actually, about how this is more than just a cyclical market because of the U.S. government's involvement. It has become absolutely structural. And it is not going to change. And I really believe that it doesn't matter what happens in 2028. that I think this momentum will continue, because I actually saw it. Now, I actually started seeing, obviously it started under Trump 1.0, but there were things that happened, and I think the Biden administration deserves a little bit of credit. The IRA did have critical minerals on the list and trying to move in the right direction. Obviously, didn't go nearly as far enough, but they did approve the Stibnite project on their way out the door. So they deserve a little bit of credit for some of the stuff. Now, Trump 2.0 comes in, and like it's the doors are wide open, capital is flowing. They're very transparent on where they want this thing to go. And we'll probably continue to see more. In fact, it's been a couple months since we've got the last news of the U.S. government taking a position in some sort of project or company, and I'm looking at my clock and I'm wondering, all right, well, where's the next one going to land? So it's been a little slow that way, but it's structural in nature. Like, this is where they are demanding capital to flow, and I think that's definitely where it's going to happen. And when the U.S. government does take positions, it's huge de-risking. It's hugely de-risking for capital to go that way. We saw J.P. Morgan taking in a huge, huge in our mind, not huge in J.P. Morgan's mind, but a stake in the Stibnite project. Honestly, I don't even know the last time a massive financial institution took in equity stake in a developing mine story. Like, that's fascinating. So we're on the right track. We're moving in the right direction. So
I agree. It's huge affirmation that we're in the right sector and that it was worth it to stick around, right? And stick to our guns, because people are going to follow that leader. And you're absolutely right. It's a big security buy when we see these bets made. And I think I don't know your take on this. I'd actually be really curious, but it also makes me think very differently about jurisdiction. And I'd say jurisdictional risk, but really it's just jurisdiction. I look very differently at the countries that are going to be playing favorably with the United States, because any assets that are in favorable to U.S. jurisdictions are far more likely to be protected, to be moved forward with urgency, and to be fast-tracked if necessary, right? We moved from 35 metals on the critical metals list in 2018 up to 60 today. Like, we'll have the whole periodic table on there in a couple of years if this trend continues. And that just means is that they're serious, right? They have now the rationale. This is on the critical list. We need it. We're going to move forward because this is an issue of national security. And it's in Mexico, it's in Canada, it's in Australia, it's in Peru, it's in Chile. Doesn't matter. We need it. They're our friend. Let's get this done, right? American capital will move in. And I think we're going to see more of that.
Which leads me to the relationship between the U.S. and Canada. Can you and I just solve this problem right here on the podcast right now, Jay? Like, what the hell, man? Like, this should have been the easier one. It doesn't matter who's in office. Like put down the grudges. Like, I mean, your sourcing of material, between Canada, the U.S., Mexico, like, problem solved. Just get along.
Yeah, it doesn't, you know what, man, I don't put any weight whatsoever on the rhetoric that was flying north and south, and it drove me crazy. So many of my friends in Canada were just irked by the 51st state conversation, and I didn't understand why. I'm like, just spend 5 seconds thinking about this, guy. There's obviously never, ever been any validity to this. I mean, first of all, notwithstanding, Canada's a very liberal country. Trump's going to annex a country and import 40 million Democratic voters? Like, probably not. I doubt it. It doesn't make any sense, right? But it's the largest land border in the world. Canada is one of the most heavily resource endowed countries in the world. That's why $2 billion worth of goods cross that border every single day. That's never decoupling. Everything else is just headlines and narrative, right? And it serves a means. I mean, if you look at the campaign that the Prime Minister of Canada ran, Mark Carney, when he replaced Justin Trudeau, when Justin Trudeau resigned and Mark Carney took his place. And then it was Mark Carney running against the heavy favorite, this guy, Pierre Poilievre, which people had fallen in love with because he was so witty and charismatic. A complete, well, we can cover that later, but a guy who self-identifies as a libertarian, but has never had a job outside of politics. Like, why would you listen to a thing that he has to say? He's entertaining for sure, but this guy's a joke. Anyways,
well spoken.
Very well. So fun to watch. Like, don't get me wrong. I enjoyed the campaign. But when Carney took the podium to run properly, you'll notice he didn't run against Pierre Poilievre. He ran his whole campaign against Trump. It's the only other politician he ever mentioned in any of his speeches. And that's all this like rhetoric really does. It serves the political needs and all this. But from an economic standpoint, there's no decoupling from the US. Carney wants to triple non-US exports in the next 5 years. I think that's a great idea. You should always have optionality. Canada also has the longest coastline in the world with access to every single global market, but none of them are ever going to be as cost effective as just trading with the US, right? It's like $31 trillion of natural resource wealth in this country and the wealthiest and hungriest customer on the other side of that border. So that's, short-term blip in the relationship, but it's not going anywhere.
What is the, within Canada, what is kind of the sentiment towards Carney right now? I mean, I see everything on Twitter or X or whatever, like, I take it for a grain of salt, but what are you hearing?
Again, okay, so first of all, I'll preface this by just saying I do step out from like political sentiment conversations because I tend to think they're all the same. And, this guy, that guy, like, it's just different coat of paint on the same car, right? The real policies don't tend to shift that much. I didn't vote for Carney. However, he's been a pleasant surprise. Not hard to do when you're replacing Justin Trudeau, but he's also put an emphasis on the extraction industry in a way that Canada desperately needs. Like, Canada's a really simple country. It's colossal. It's the second biggest country in the world with less people than the state of California and incredibly resource rich, right? Like 30% of the world's potash comes from Canada. If you want to grow anything, you need potash. 25% of the world's softwood lumber, right? Nickel, lithium, the richest uranium deposits in the world. Like, it's so resource rich. If you let that industry thrive, notwithstanding the oil and gas, of course, like it goes on and on. If you let the extraction industry thrive, then yes, all the ancillary industries in Canada can thrive too from the cash trickle that comes off the rainmaker. But if you vilify the rainmaker, nothing works. Right? And this is why Canada came through the 2008 great financial crisis with a healthier balance sheet than any other G7 nation, because we had a leader, being Prime Minister Harper, who favored the extraction industries and leveraged those strengths, and everybody got to benefit from the cash trickle that came off of that. Whereas today, after 15 years of demonizing that sector, Canada's GDP per capita is on pace with Alabama right now. Like, it's not a pretty picture. Now, it's in theory easy to correct because we know what formula works. And I believe that Carney understands that. He was the governor of the Bank of Canada in 2008, right? So although he held his hand up and said, I steered us through that crisis, the reality was it was easy to steer Canada through that crisis because of Canada's economy from 2005 to 2008. That's why we got it through. Regardless, he would have seen the evidence. He understands. He's a very smart guy, right? Carney, call him whatever you want. People like to globalist this, whatever. Like, again, not my fight. I don't care. I'll build my business and worry about me. But he is very smart. And, the Special Projects Office, he is expediting regulation and fast tracking important projects, and a micro version of what we're seeing in the United States, government stepping in and pushing resource projects forward. We're seeing that in Canada too.
Yeah, very cool. All right. Hey, I want to get a big picture here. It's kind of maybe stepping away from precious metals and the macro. You've got a course that's available online. Is it Commodity University? Is that what it's called?
That's right. The Commodity University.
Yeah. Awesome stuff. Listen, if we remove the major metals that we are watching day to day, any niche metals or part of the commodity space you think maybe is going to be most surprising as we move in to the new year? And I'll let you answer first, and then I'll give you mine.
Yeah, that's a great question. What I would tell you is that I think the rare earth sector, despite the sudden general interest and headlines all over the place, is still vastly misunderstood. And rare earths are not rare. They're incredibly abundant in the Earth's crust. And the bottleneck is not the supply or discovery of the resource, but the refinement of it. And I think that's a sector within our industry, Trevor, that's going to confound and disappoint a lot of people. Now, look, like, people might not like to hear that, but I just have to have way less confidence in these more obscure metals because they don't have the tried and tested history. And, I believe firmly in the Lindy principle, right? The relevant expected lifespan of a thing is best projected by its historic relevant lifespan, right? The book is a great piece of technology. It's been around for thousands of years. I have high confidence we'll still have books in thousands of years as long as we're still here. But, newer technology, you have to question that, right? And most of these rare earths are utilized in innovative, disruptive tech that has the ability to engineer inputs out if that input is hard to procure, right? They're not exclusively, right? Rare earths are not just for missiles and AI. They're used in the electric window in your car. Any kind of, engine requires these magnets. But I think the supply is very misunderstood, and that's one that may not materialize the way people are forecasting.
Okay. My biggest question in this entire boom, like I'm looking at, I've got some capital allocated to the BlackRock Commodity Mutual Fund in my retirement account. That thing has just been up and up and up all year long. And it's done it without oil. Oil market, like $55 a barrel wherever we're at, WTI. Could you imagine where the entire commodity complex would be if we actually saw a move in oil? I kind of feel like next year, like we're kind of poised to make that happen because it's sentiment's in the tank. Nobody wants it. There's, people want to keep the price lower for energy, and yet we need more energy. So I'm thinking oil is going to be a face ripper in 2026.
Yeah, well, there's some very smart money that agrees with you, right? I know I was chatting with our mutual friend Rick Rule just 2 weeks ago, and he's allocated a ton to both American and Canadian oil and gas companies. His time horizon's around 4 to 5 years, right? But you're in good company on that one, Trevor.
All right. It's not a dumb idea then. All right, man. All right, Jay. It's good to see everybody. I will put a link to the Vancouver Resource Investment Conference registration page. It comes in at a whopping cost of free. So I highly recommend, if you can make it into the Vancouver area, if you're not already there, sign up. I'm really looking forward to this. It's a great way to kick off the new year, really. Jay, what are you most excited about this year, other than, the booming sentiment?
Yeah. We're building the agenda right now, which is my favorite part. So 2 days of just crammed content on 6 stages at this event, January 25th and 26th. And yes, general admission is free. When you walk into the conference, you walk into a trade show. So it's like a marketplace of around 285 junior mining companies, all of whom want your investor dollars. So it makes sense to me that they should therefore pick up the bill for the conference, because we fly in around 100 keynote speakers. It's a big production, but if you have any interest in investing in the mining sector, this is like the Super Bowl of information. And that's what we build. So anybody who takes our stage has shown us a track record of allocating capital intelligently in the mining sector. And we invite them out to show our audience where they're putting that cash next. So where is the money going in 2026? We're pretty holistic with the content, Trevor. So we start right at the top. A lot of heavy geopolitical conversations, individuals like Colonel Douglas McGregor, Pascal Lota. We just signed somebody. Oh man, I can't talk about it yet, but there's always like a few ringers that I'm super pumped about. You're gonna have to wait. I know.
Cliffhanger.
It's big.
It's Tucker Carlson, isn't it? It's Tucker Carlson.
Check back on the website. But from let's just say from a geopolitical defense and material standpoint, I can't think of a bigger name. And so we start with the geopolitics, then we get into the macro, right? So how does the geopolitics of the world shape monetary and fiscal policy? And you'll have a lot of folks like Danielle DiMartino Booth, Nomi Prinz, David Rosenberg, a lot of the sort of best macro minds that we have access to. And then we keep going all the way down into the metals themselves, capital allocation, right into the mining equities, and our bread and butter, which is the exploration companies, right? The early stage stuff. That's what we do very well. So it is sort of top of the funnel all the way down to the early stages of the sector. But it's a blast, man. VRICmedia.com. And if you do want like behind the scenes access, you want to meet Robert Kiyosaki, or you want to meet Rick Rule and have a conversation with them, then grab yourself a VIP ticket, because that gets you behind the curtain. You get to meet all the speakers, attend the keynote speakers, cocktail party, a very sort of special and exclusive events, catered breakfast and lunches. You get to meet the other VIPs. It's the behind the scenes ticket. Tons of fun.
Yeah. All right, Jay. Congratulations on another successful year. Can't wait to see you in Vancouver end of January for VRIC. Looking forward to participating and providing some insight as well from my podium. We'll talk to you again soon. Best wishes, holiday season's greetings to you, your family, and everybody over at Cambridge House. So thanks so much.
Likewise, Trevor. Thank you.
David Garofalo is a pillar of the resource sector. He was the head of Goldcorp, one of the world's largest gold miners, before it was acquired by Newmont in 2019 for $10 billion. David has also had executive stints at Hudbay as well as Agnico Eagle. Currently, he is the CEO of Gold Royalty, and he's a chair of gold mining. This year, Gold Royalty was also involved in one of the resource sector's most interesting transactions. Tether, the stablecoin company with a market cap of $180 billion, bought an 8% stake in Gold Royalty in October. David, welcome to Mining Stock Daily.
Nice to see you, Mike. Thanks for having me on.
David, let's start with your journey. How did you become interested in gold mining?
Well, I actually started as a CA way back in the day with Deloitte's, and worked my way up from a very junior position at Inmet Mining, which was one of the predecessor companies of First Quantum. And we built a number of mines while I was there, and really learned the business from the ground up. And from there went on to Agnico Eagle, and then Hudbay and Goldcorp, and now Gold Royalty, which we founded just 5 years ago.
We're talking about new beginnings, and I would say Gold Royalty is a bit of a new beginning as well. The company, I think, started in 2020. Can you tell us what you see with the market opportunity with Gold Royalty?
Well, look, we've gone from 18 royalties at our inception when we IPO'd in March of 2021 to over 250 royalties. So we've steadily and almost exponentially grew the business in 5 short years, and now have 7 cash flowing royalties, another 14 in various stages of development. 360% growth in our geos projected over the next 5 years. So by far the best growth profile in the royalty universe, even among the seniors in the space. And we're debt free now and generating free cash flow and growing free cash flow over the next 5 years because our cost structure is quite stable. And our geos are growing to upwards of about 30,000 ounces by the end of the decade. So that's a lot of free cash flow. At 4,000 gold, it would be north of $90 million of free cash flow from the business per annum.
There's a number of gold royalty companies out there. What would you say would be your particular niche with Gold Royalty?
Well, I think we have a couple of niches. One is that we have royalties on 3 of the 5 biggest producing gold mines in North America: Canadian Malartic, Côté, and the underground extension of Goldstrike, a project called Ren, which is going into production next year. So we have some foundational elements to that large portfolio that will be spitting out royalty revenue for decades to come. But we also have significant diversity, over 250 royalties, a lot of optionality embedded in that. But also importantly, over 80% of our royalty portfolio by number and value are concentrated in Nevada, Quebec, and Ontario, which are 3 of the 5 best jurisdictions in the world as judged by the Fraser Institute for mineral potential, low political risk, and low regulatory risk.
It's been an interesting time within the mining sector right now, David, because I've noticed that there's been a switch to, how would you say, going into riskier jurisdictions. There's people that have been embracing, how would you say, mining resource. It's time to build things as well too. I just saying, is you seeing larger, because you do have a focus within North America, but you see that people are going further afield?
Yeah, for sure. And look, there is a tremendous need for battery metals, copper, not least of which, the demand is burgeoning, the supply not so much. So, of course, I think that mining companies are going to have to take on a little bit more political risk, a little more regulatory risk in order to get these projects up and running to meet what's really almost insatiable demand for copper. So I do think that you're going to see mining companies go further afield. We've seen that recently with Barrick when they're looking at Reko Diq and what is seemingly a very difficult jurisdiction, but there's such a demand for this metal that eventually we're going to have to see a little bit of dilution of the political risk profile of some of these companies to deliver the kind of growth that the base metal universe needs. I think in the gold universe, we're still finding lots of opportunities in our backyard in Nevada, Quebec, and Ontario. We continue to populate our pipeline with early stage opportunities through our royalty generator model. That's generating 2 to 3 new royalties per quarter to continue to populate the early stages of our pipeline. And what we're also seeing, given these gold prices, is third-party royalties on cash flowing assets are increasingly becoming available as we see companies start to monetize royalties that are non-core to their portfolio.
Let's talk a bit about that pipeline, David. Gold has just had this tremendous run. It's still a little bit fresh, but maybe we can say that it certainly got legs at the beginning of the year. But are you seeing a change in the pipeline right now? Look, you've been in this business for a very long time, David, and then these types of projects that are out there. But are you, is things getting dusted off the shelf? Have you really noticed like a real change in economics? And also, is the industry and is the exploration developers being able to respond quickly to these elevated metal prices?
It's a good question because it's been a nuclear winter for the explorers and developers for a good dozen years. There hasn't been consistent access to capital. So I would still say selectively, we're starting to see the market open up for those earlier stage explorers, ones that have significant discovery potential. That's great. We need that. The industry desperately needs it because all the industry's been doing for the last decade or so is basically cannibalizing itself. It's not growing the pie of resources in the ground. It's quite the opposite. We've seen a steady decline and deterioration in the number of ounces of reserves in the ground since the peak back in 2012, in fact, down about 40%. So yes, we are seeing selective access and improvement, and there's going to be discoveries that come from that. The only way to make discoveries is put dollars in the ground, and we haven't seen dollars put in the ground on a consistent basis for well over a decade. So I'm optimistic that'll mean new opportunities for us to finance new projects, new development opportunities, and hopefully that'll start to populate our pipelines as well in the royalty and streaming universe.
You say hopeful, though. I mean, would you say that there's been a quantitative difference in terms of the amount of opportunities from, say, like a year ago at the same time with, certainly different gold prices?
Yeah, look, we see a steady set of opportunities presented to us. In fact, we probably put in, bid letters on royalty opportunities at the rate of 1 or 2 a month. We actually haven't executed on a royalty deal in a year and a half of any significance because what this price dynamic in the gold universe has done is really made it difficult for royalty and streaming companies to pick a price assumption in order to value these royalties because it's gone up like a hockey stick, the gold price has. So I think everybody's all over the map in terms of what gold price assumption they use to value these royalties. And so we've been priced out virtually everything that we bid on in the last year and a half. And we've had to be disciplined. We've had to kind of sit on our hands and not try to chase these things and wait for the gold price to stabilize and get into a range where we can as a royalty and streaming universe, use consistent price assumptions to value these things.
David, I hear quite often, and maybe you can help me understand this. I hear people talking about a healthy gold price as opposed to a rocketing gold price. What's a healthy gold price? What does it mean? And what do you think that number is?
Well, look, I think we're still not at what I would characterize as incentive prices for gold, ironically, even though we're at all-time highs, because we haven't seen a proliferation of new mine development. And part of it is a function of the lack of exploration success because the explorers haven't had the capital to do it. But also, I would say that cost structures are probably significantly higher than most people assume. And that means the gold price is not high enough to incentivize a lot more exploration, a lot more mine development to replace what is still continually depleting reserves in the industry.
Let's go macro for a bit. Let's talk about gold prices. What's the smartest analysis you've heard on what's gold doing and where it's headed, David?
Well, I've always called gold a currency, not a commodity. If we ever tried to make an argument for gold on demand supply fundamentals, I think we'd struggle because there's so much central bank reserves and investment reserves sitting above ground. In fact, every ounce that's ever been mined is just sitting above ground. So there's always that supply ready to come into the market. really the reason gold does so well is because it trades well relative to other currencies when there's no opportunity cost of owning gold, and interest rates are so low on a real basis, in fact, negative in our view. I think inflation is quite a bit higher than the headline numbers might indicate. That gold is just basically agnostic barometer, an accurate barometer of where inflation really is, and the debasement of fiat currencies is. That dynamic has been underway for well over 15 years, really since the great financial crisis, and that steady debasement of paper currencies is really what's driving the gold price up. Purchasing power of our dollars, of our fiat dollars, are going down every year. And even to put it on more historical perspective, it really goes back to when we abandoned the gold standard in the early 1970s. We've seen the gold price go from $35 an ounce to $4,300 an ounce today. And we've seen the purchasing power of our currencies collectively in the Western world go down by about 98, 99%. The relationship is very linear. Even when there's volatility in the interim, it's really a function of the purchasing power of alternative currencies that's really driving the gold price up.
David, we talked about your career and you've been following gold for a very long time. I'm interested about what is the macro that you actually look at when you wake up in the morning, what metrics, of course, you're going to be checking on the metal prices as well too. But I was interested talking about your gold theme. What are some of the other macros that you actually follow in the markets?
Well, in our sector in particular, I look at all-in sustaining costs and trends in operating costs. And that's instructive because that tells me that it answers the question, are you getting leverage as an investor in our universe, in the producer universe in particular? And I'd say in the short term, recently, we've actually seen quite a bit of leverage provided by producers where we've seen an expansion of margin. As the gold prices rocketed up, operating costs actually have stabilized. We've seen oil prices stabilize. We've seen labor costs more or less stabilize, so they do go up every year. It's inevitable and invariably going up. But we haven't seen the kind of contraction of margins as operating costs rocket up to keep pace with the gold price recently. So we've seen the producers actually perform extremely well. But what we've seen over time, and this is over a 30-year horizon, for example, is the EBITDA margin in the industry is pretty much static at about 30%. You do have periods like we have had recently where we've seen the gold price rocket up and margins expand, but invariably what happens is unit costs start to go up because of inflation in the general economy. But also when you have a gold price rocketing the way it is now, invariably what happens is the producers start to mine lower grade material, because that lower grade material, which might have been uneconomic at a lower gold price, is suddenly economic. And it's a responsible thing for the producer to do, to put that material through their mills and concentrators and recover it and generate a margin. But when you mine lower grades, then it does depress your production and increase your all-in sustaining cost per ounce. So I do think what we'll see is lower grade materials start to go through the mills and concentrators, and we'll start to see that margin contract again and get back to that median margin of about 30% of EBITDA, that we've seen historically. And I think that'll come back. And so I think then investors in the gold sector will start to rotate out of producers back into royalty and streaming companies, because we are completely impervious to inflation, and our margins will go up as the gold price goes up unmitigated.
I'd like to stick with inflation and costs for a minute, David. You do have a view into this, certainly also being a chair of gold mining, which is, I believe, the prospector model that have. It's odd that we just seem to be in a very sweet spot right now with the gold miners, just because oil being one of the most important kind of inputs and the cost driver, that has been low right now, whereas everything else is rocketing right now. So where are we seeing these other inflation drivers that are coming up? Is it labor? Is it steel? Is it And you did make the point, obviously as well too, that we're kind of milling stuff that might be of a lower grade.
Yeah, I think that's going to be the biggest variable in terms of unit costs, is lower grade material sneaking into the mills, and that's inevitable. That will happen. Labor costs at these all-time highs in the gold price, copper price, those significant LME metals doing very, very well. I think you're going to see labor cost pressure first before you'll see energy cost pressure. But I think, again, the biggest factor driving up unit costs will be the processing of lower grade material at higher gold prices that make money at these higher gold prices and wouldn't maybe in a lower gold price environment.
Let's go back to gold royalty. I mentioned at the top that there was that transaction in October by Tether. Can you tell us what you think that Tether was doing in terms of investing in gold royalty?
Well, look, I think what Tether's done is brought a new capital, a new pool of capital into the sector that wasn't there before. And Tether, for those that are not familiar with it, are a stable coin fund backed dollar for dollar by U.S. Treasury. So you buy a Tether coin, and that dollar for that Tether coin goes and buys a U.S. Treasury. You don't get any interest on those Tether coins, so that yield accrues to the operators of the Tether coin fund. They're using that yield, those interest income, which is being generated at the rate of several $billion per quarter, and deploying that into hard assets. I think they, like us, believe that the U.S. dollar is being debased, so they're looking for ways to diversify away from the U.S. Treasuries into other products, and they've been buying physical gold to almost reckless abandon. They're out there buying billions of dollars of physical gold, perhaps the biggest buyer of physical gold currently in the market, even surpassing some of the sovereign central banks. And they've also bought agricultural property, they bought Bitcoin. So they are significantly diversifying their holdings. And now they're looking at streaming and royalty companies as a way to provide leverage to the gold price, seemingly. And they've taken minority stakes in a number of companies. They've taken control of Elemental and recently EMX royalties, but they've taken stakes in us and Versamet and Metalla on a minority basis. And look, I think that's bringing welcome attention to what was previously an ignored part of our sector, the small cap royalty space, which is the one that's providing, that part of the segment of the royalty universe is one that's providing all the growth and leverage to the gold price. And as good as the big guys are, Franco, Wheaton, and Royal, they're fantastic companies with fantastic portfolios and exceptional management teams. They're at a critical mass where it's very difficult for them to grow. And what we're providing in the smaller cap universe is growth. And certainly Tether's recognizing the growth and leverage inherent, embedded in our collective portfolios.
Explain again why you're poised for growth, whereas the seniors are not. It's just that you can move the dial, whereas probably the seniors cannot.
Yeah, look, at Franco-Nevada, Wheaton, they're 100 times our size. That means for a deal that moves the needle for us, Franco and Wheaton have to find something 100 times the size of something we would do in order to move the needle. Well, those opportunities simply do not exist. You know, we're talking about the $10 to $20 billion type transactions, and they just don't exist because of the lack of investment and exploration in our universe. In the metals and mining space, there isn't those pipeline projects that Wheaton and Franco and Royal can provide capital to help construct. There isn't those pipeline opportunities. So we're just in a much better place to do $50, $75 million deals, $100 million deals. Those meaningfully move the needles for ourselves and some of our peers, whereas for Franco and Wheaton, that's less than a rounding error for them.
You mentioned Elemental. You did take a run at Elemental, I believe, in 2022. It didn't work out, and they went and merged with another company as well, too. They do have a controlling stake. I think Heather's got plus 50% in Elemental, and then they've got the 8% with you as well, too. Is there anything that else is happening organizationally regarding those two stakes that you know of or can talk about?
Yeah, no, look, I think everybody in the small cap royalty universe recognizes the M&A cycle that we find ourselves in. And the reason that's happening is because by achieving critical mass, typically you get a better multiple or re-rate. And I think Tether recognizes that and sees the potential of M&A in our space. The other value proposition, of course, is when you put these companies together, you can also eliminate G&A and realize significant synergies. And, you know, for example, we rolled up 3 royalty companies over the course of 2021, Ely, Golden Valley, and Abitibi royalties, and we eliminated all of their G&A costs, which collectively was about $10 million per annum. That's a lot of value creation coming out of the gate. So I think as M&A happens, then G&A synergies can be realized, critical mass can be achieved, and that will help hasten the re-rate, drive up multiples, lower the cost of capital. And at the end of the day, we're banks, you know, and our cost of capital is really what drives our ability to do deals. And so driving down the cost of capital is absolutely an economic imperative for any of us in the royalty space.
I wanted to go back and then ask about you being chair of gold mining. That is the project generator model as well too. What is the is there synergies between those two? Can you do synergies between those two?
Well, we were spun out of gold mining 5 years ago. We have royalties on each and every one of their projects.
Yeah.
And what we've done is provided them a marketable security that they can leverage to work those projects. So I think the synergy comes from the symbiotic nature of our relationship. We have royalties on their properties. They own an equity stake in us. They can use that equity stake to help fund the underlying exploration and development of those projects, which enhances the value of our royalties. So we want to see them succeed, and that's why I'm co-chair along with my co-founder of Gold Royalty, Amir Adnani, in that company, because I want to see, and my management team wants to see those underlying assets developed, de-risked, brought forward, so that enhances the value of our underlying royalties on each and every one of those projects.
Industry question, David, leaning back on your years, decades of experience and exposure to this gold sector. What do people do now? Where are we right now? We've had a year of this, absolutely. And then it seems like the party still keeps going right now. So what do you see that's going to be happening with the seniors? What do you see that's going to be happening with the exploration companies? Where do you think we are in this cycle? And what do you do strategically? What do you do next, David?
Well, look, I think there's going to be continued M&A in the sector because, as I said, the lack of growth in reserves in the ground, in fact, it's not a growth, it's decline, means that the sector has to continue to cannibalize itself among the producer universe. So you're going to see more of that cannibalization occur to sustain the production levels that some of these larger companies need to sustain through M&A. They can't do it through exploration because exploration hasn't happened. So if you're not finding it, you're having to buy it. And that means also that you're going to see some non-core assets come out of that M&A that'll create new companies. And we've seen that, for example, in Discovery Silver, which bought the old Porcupine complex that was part of our portfolio, Goldcorp, when I was running it. And they're revitalizing that camp. And we're a royalty holder on one of the projects within Porcupine. So we're beneficiaries of their focus and reinvestment back into those complexes. So I think it's good for the sector to have M&A happen because inevitably non-core assets fall out of it, and those non-core assets get new love and attention and capital that they need to perpetuate their reserves and resources and look at expansion opportunities, which also serves our purpose because as these new companies, new entrants in the space buy these non-core assets, they need financing. And we can provide stream and royalty financing to help perpetuate the new assets they've accumulated.
Lastly, David, either you can end on a pessimistic note or an optimistic note, but what macro trend are you paying attention to, or what do you think is going to be most meaningful? We certainly hear discussions about automation. Lately, everybody's talking about AI. We talked at the beginning in terms of people kind of wading into new jurisdictions as well. There's also the challenges that it's been with labor in terms of getting people interested in the sector. What are some of the top trends? What do you think is going to be most meaningful in the years going out, David?
Well, I would love to see the more consistent application of AI in the exploration side of our business. The most difficult thing for us to do as an industry, when you look at the life cycle of a mine, is to generate new targets. And it's not terribly time efficient. It's still laborious, quite labor intensive in order to generate those targets, even in existing districts. And, we did it to a certain degree when I was running Goldcorp. We started to digitize all of our exploration information, particularly in the Red Lake district, which had a century of exploration underneath its belt, using that within the Watson generator to basically generate new targets for exploration. We need to do that in the industry in order to curtail and shorten the timelines to get new targets generated, so we can start to get some exploration success to grow the resource pile within our industry, which again has been in a very significant decline for the last dozen years or so.
David, thanks for speaking with Mining Stock Daily.
Thanks for having me on.